Awesome. Hi, everyone. Thanks so much for joining. My name is Malhotra. I'll be moderating the webinar today. And on we also have Vyas and Sapan Vyas, who will be joining us and joining us to help educate all of us on investing. So just as a little bit of background, our Fearless Beta cohort just completed their Intro to Investing sprint last week. And so as a capstone to the content on the platform, today we want to bring you an expert, Sapan Vyas, who is an investment expert. He'll share his experience on investing in the markets, how to get started, and why it's important to learn about it early. Like I said, my name's Kuran. I'm a Fearless mentor. I have been working with the team here since the beginning of the summer, and it's been absolutely incredible. I also am an analyst at Insight Partners, a venture capital and growth equity firm based out of New York City. And so I'm very excited to be here. And Sapan, thanks so much for joining us.
Thank you. I'm very excited to be as well, Karen. Thank you for allowing me to join.
Yeah,
it's wonderful.
Yeah, absolutely. So just a little bit of background on Sapan. He was born and raised in the Bronx. He attended Bronx Science High School and graduated from Binghamton University with a bachelor's degree in biology with honors. He's currently the co-chief investment officer at Kimmelman Baird, an investment advisory firm with $1.5 billion in assets under management. Sapan has 20 years of extensive markets experience focusing on portfolio construction, risk management, and asset allocation. He's a CFA charter holder, and he serves on the board of the Bronx Children's Museum. He's also an avid golfer, a big New York Giants fan, as am I. The Giants, not the golf. And we're super excited to have him here today to share his experience with us, learn how he got started with the markets, and really just share with the entire cohort. Just a quick reminder before we get started, we want to let everyone in the audience know that this expert series is for informational purposes. Our goal is to inform you about investing and the options you have as you learn about what might be the right approach for you. None of the following should be construed as advice to invest in any particular security or index. And with that,
sorry, Karen, only other thing is, as we're going through this moderation panel, we are going to be keeping an eye on the chat. So any questions that come in from our audience, we will be monitoring it, and we will have some time at the very end for Q&A. So for those of you that have tuned in, please fire away your questions. We will be reading them, and we'll make sure we get to answer all of them. So that's it. Fearless Mentor, over to you.
Yeah, with that, let's dive in. Sapan, I'd love to get started with a little bit on your background. You were in college pre-med, and now you're an investor. So how'd you get here?
Sure, that's a great question. I think perseverance, a little bit of luck, surrounding yourself with smart people, all of the above. So, like you said, I think we're getting a little feedback. So are we good? Okay. Like you said, I went to school with the intentions of going to medical school. So I was studying to be a bio major, which I did do actually for all 4 years. I was, so far into it when I sort of was thinking about maybe looking and getting into the business field. And, I was really lucky. I had a great mentor who was a business owner in the area, and I was working a lot with him during the summers. And, he just had such a big impact on my life that there was more to just sort of the traditional route growing up as an Indian, young man, about being either a doctor or an engineer or a lawyer, as cliche as it sounds. And so, there I was, senior year, sort of completed all of my undergraduate requirements and was figuring out what to do, and jumped into a bunch of business classes, really enjoyed it, and started hustling in my network. And if we really want to be specific, which I'm sure all the, Fearless cohort out there would love to hear, my sister at the time was at NYU, a year behind me, and being at Binghamton and being a senior, I really was sort of scrambling of where to look for job opportunities. And being a New York City university, she just gave me access to log into her job board. And the firm that I'm at now had a posting, and 20 years later, here I am. I went in for an interview, and, they were very impressed. They offered me a job the same day. And that was 2001 in June. And I really haven't looked back since. That's honestly the specific story. Just kind of good break. Obviously, I was taking care of the grades part in school, but yeah.
Wow, 20 years almost to the day. That's pretty incredible.
Over 20 years now. Yeah, a little over 20 years now. June was my anniversary.
Wow, very nice. So I guess for all the younger cohort out there, When does it make sense to start thinking about this, to start thinking about investing, and what does that actually do for you?
So I think that's a great question. So maybe just a quick background on myself, and what we do at the firm. I mean, the bulk of what we do in managing the money that you described is really helping families. So our firm has been around for over 50 years, and obviously I've been there for 20 years of it, so a significant part of the history. And throughout that 2 decades of experience, I've just seen what the markets can do for families, and how it can really help them achieve all their goals. And if you think about a family, I'm talking about multiple generations. So for the kids that are on the call, think about your parents, your grandparents, and how growing and investing in the markets, what that can do for you, help you pay for college, and all of those kinds of things. So I think all of that comes from all of that experience that I've seen. Shows that the longer you're in it, the greater you can, the greater returns can exist and the better you can do. And therefore it's never too soon to start. And I think you have a slide showing sort of, about the age groups and, Karen, I don't know if you want to flip to that or if that's too soon, but I'll throw it back to you.
I think why don't we start here actually with
Okay.
Percentage of people investing before the age of 25, age
Right.
25 to 34, and then just the average age in general.
And I think this is a great slide showing that, the point of what you were making about getting in early, right?
Yeah, absolutely. And so, as a young person, it might be daunting to start thinking about the various different types of investments out there. Can you walk through just what some of those types of investments are? What are the most common? What are the most easily accessible? And then from your experience, like, what do you work with the most?
Sure. So I think, for our audience, I think just think about all the things that you use in your everyday lives. So let's take some simple things like the iPhone, right? Everyone, has an opinion. For the most part, people love their iPhones. We see Teslas on the road all the time. We use Google to search. So these are companies that we all know, that we all interact with on a daily basis. Many of them end up becoming public companies. So what does that mean? It means that you can actually buy shares of them in the market. And so I think the best way, for me to explain it is, there can be a collection of companies like that are publicly traded, which means that you can buy shares of them, and they touch all different industries of things we do, from what I just mentioned about using search and social media and our phones, and how we pick up garbage in communities, how we make products, factories, et cetera. All of these things are represented in various ways in the public markets. And so for our young group here, I think what the best way to think about it is, how do we buy a basket of those securities, right? So of those stocks, it's the same word, security, stocks, interchangeable. And so what I like to tell people, and what many folks may have heard about or read about, is something called the S&P 500, which is basically a basket of all of those companies that I mentioned, different kinds, and they're all lumped in together, and you can buy a portion of that basket, which basically I like to say represents sort of the economy in America and globally. And it's really easy to do. There's many different platforms where you can buy shares of an index that represents the S&P 500. And that's basically making a bet on the growth of America. That's the best way I would explain it, Karen.
Yeah, no, I think that definitely makes sense. I mean, you talked about platforms. What platforms are out there, and how can you actually get access to these indexes or these funds?
Sure. I think so. For us, obviously, at our firm, when people are older and have larger amounts of money, they come to us, and we would be the platform in that case. But I think in our young group, think about some of the places that you see, Fidelity, TD Ameritrade, Vanguard, things like that, where with small amounts you could put money in, open an account with your parents, you can put money in, and then basically you would be able to select something that would represent, again, what I said, which is the S&P 500, which I think is a really important point, and it's a starting block that everybody here that is thinking about putting money in the market should have. And this is a fantastic slide that basically shows you what investing early and what investing regular basis can do over time. And Karen, why don't you, do you want to talk about the slide, or do you want me to talk about the slide?
Yeah, no, I mean, I'm happy to talk about it a little bit, and then feel free to jump in too. But effectively, what this is showing is the effect of compounding, right? And so compounding is the idea that as your money grows, the amount of money that you're making on that will kind of continue to grow with it, right? And so instead of just having $1 or $100 growing over time, and you keep getting 5 or 6 or 7% on that $100, after your first year, you're getting 5 or 6 or 7% on the $105 and so on and so forth. And then on top of it, it's showing the value of how that changes, even within 1 year, right? So if you invest $100 a month in 2003 versus 2004, the amount of money that you'd have today, it changes pretty drastically because of that effect of compounding.
I think that's exactly right. And, again, we're looking at periods of time where obviously the market has done well. And when we say the market, we're talking about the S&P 500, because again, it's a broad representation of America and American companies that are invested globally. And so it's a really good feel for what's happening. There are certainly times where the market will go down. There are times where the market will go sideways. Basically, there will be fluctuations. What we're pointing out here is if you have a long-term view, what can happen. And, if you look at something like this, which is $100 a month for 12 months, so it's basically putting in $1,200 every year. If you did it for 10 years, it's 12,000. So we're talking somewhere around $20,000 from the age of, birth to 18. If you look at what that 18-year-old person that started in 2003, what that $20,000 could have turned into, Karan, you can show that there. I think it's something like, $70,000, I believe. So
Yep.
It's basically your money has gone up more than 2.5 times, right? And so that's really powerful. This is not something that's guaranteed by any means. All we can guarantee when we talk about the markets, and it's another important point for young people to understand, is that the markets will go up and they'll go down. But you want to be able to put in an amount that doesn't affect you while those fluctuations are happening, because you've taken that long-term view. And that long-term view covers ups and downs. If you notice, you'll see some of those, like the blue line has some dips in there, and in the beginning and in the end and in the middle. So those dips represent times when the market will go down, and those things happen because our economy slows down. We've all lived through COVID, and when COVID initially set on, a lot of companies were affected by it. They still are. Something that happened in 2008 and 2009, which may be a little bit longer away from our age group here, but we had a financial crisis globally where we really had a stress on the financial system. And so anytime that there's uncertainty or what we call volatility in the markets, stocks go down, because stocks don't like uncertainty. They like things to be nice and, in good spirits, and, the ocean and the beach and, all the things that we associate with sort of fun times in our lives. That's what the market's like. But we know that we always have turbulent times in our lives as well, and we have to be prepared for that.
Yeah, absolutely. As part of that, I think here's another slide that shows a little bit on the power of investing. If we think about investing $1,000 in Apple in 2003, for a lot of people watching, that might be around the time when you were born. That's how much money it would turn into today. I mean,
it's almost scary when you talk about it, right? I mean,
exactly.
I think we should explain to everyone in the audience that you had to have the insight and the vision to think that Apple would become the company that it's become today. It's probably also equally difficult for everyone on the call here to imagine that Apple was once not the company that it is today. In fact, Steve Jobs was fired from his own company and sort of came back and took over and created this amazing, achievement. But there are also lots of investments that don't work out and that don't turn into this. So this is incredibly powerful. We've picked an example here that everyone can relate to on the call. It's also one of the greatest examples in all of history of investing. But there are many examples of companies that have done well for a really long time and then sort of lose their luster, which is why it's really important to be diversified. And that's why, going back to sort of discussing the S&P 500, it's a basket of companies that represent all sorts of different industries of things that we use and touch in our everyday lives. Think about toothpaste and dishwasher soap. And like I mentioned earlier, the companies that come outside and pick up your garbage, companies that make tires for cars, gas that goes in the cars, our clothing, our food, all of these companies are represented in the S&P 500, so that when some are doing really well, others might not be, but they can all sort of lift each other up over a long time frame.
Yep. Yeah, absolutely. And so on that note, Sapan, what is the benefit of working with an investment advisor or an asset manager? Does that help in kind of creating this diversity within a portfolio?
Sure. I think when again, for our sort of really young age group here, it makes sense to use some of the platforms that we mentioned, whether it's a T Rowe or a Fidelity, et cetera. I think when you start getting out in the workforce and you finish college and you're doing all these amazing careers that Fearless is hopefully going to help you with, it's really important to know that you're going to be spending your time on your day jobs with your families. And we live in such a specialized world that it's very difficult to also keep your eye on your money, especially as it grows. And so that's one area where financial experts, investment advisors like ourselves really add value. I think another important point to make is that, and there may be, amongst the group here that's joining us today, where you've seen during the coronavirus or other times of stress that, your parents or people that that may already be invested in the market, sort of may have panicked and hit the button, and or they didn't, because they had an advisor that they could call and that could counsel them and let them know their opinions, and obviously keep them sort of invested and make some adjustments as you go along the way. So I think the real value of someone like myself is the couple of examples that I gave of sort of helping you stay the course, speaking constantly in dialogue while you're busy with your day job, because it's life, and life is constantly evolving and changing, and it's dynamic, and an investment advisor can really help provide stability in an area that's so crucially important that a lot of folks don't necessarily understand fully, and also are intimidated by talking about finances.
Yeah, absolutely. And just one more question on that, Sapan. What is your view on kind of taking the long-term perspective, and in other words, what's the benefit of taking the long-term perspective versus a short-term perspective when you're trading?
I think maybe we should use sort of Apple as an example. Those sort of big down dips there that you had on the chart, that have happened so many times throughout this, even just this graphic here, which represents, 17, 18 years. A lot of times those dips are not related to sort of the long-term vision of a company. They can be caused by the market. They can be caused by, a lot of factors that just aren't controllable by the company. And I think those are the times, and those are the cases where you really having the long-term vision allows you to take that ride and sort of avoid being faked out on those dips. There are other times when the company has changed, right? Their ethos has changed, or the product has changed, and therefore it's a company specific reason of why you should get out. But I think having the long-term view when you believe your fundamental reason for why you made an investment in a particular company hasn't changed is really, really important to sort of stay the course.
Yeah, makes sense. And when we're thinking about long-term view, I think it's important to clarify, we're not necessarily talking about a 20-year view.
Right.
It could be a couple years. Or
I think that's what we think of, and I'm glad you pointed it out, Karan. I think the first part is a thesis, right? So you're writing a paper, you've just read a book, you're working on a project, and you have a thesis, you have a reason, and sort of 4 or 5 arguments of why you believe your argument is valid. And so we create and make a thesis of why we want to be invested in a particular company, and we try to figure out how can that thesis play out over a 2 to 3 or 4 year time frame, right? And that's how we think of it. And so, and every year, every quarter, every month, honestly, every minute, we're reevaluating that thesis in our minds as information comes across. And so, and then how does that change our time frame of what we're looking at, right? No different than, Karan, what you're doing and venturing on in your world, where you're making a thesis on, companies that are going to disrupt and change and do what they're going to do.
Yeah, absolutely. So why don't we switch gears a little bit? Let's talk about retirement. I mean, of course, it's a really long way away for a good chunk of our audience who, are 15, 16, 17, 18. But why is it important to start thinking about retirement at such an early age?
Sure. I would ask everybody in the audience, tell me the 3 things that you enjoy doing today. right? And I'm sure hanging with their friends, going on vacation, maybe it's getting the latest iPhone, right? And so what is that? That all represents your lifestyle of how you want to live. And so why is it important to start investing early, to start saving early and allowing that money to grow, not just having it in the bank earning no interest, or as we like to say, in a mattress doing nothing for you? It's so that you can maintain your lifestyle, because at some point, I know it's really hard to think that far away and that long term, but after you finish your education and you start working and you build a career, at some point you'll want to stop working to enjoy even more. And when you stop working, well, guess what happens? You no longer have any income coming in, right? And so think of this bucket that we've been talking about that's been growing for 30, 40 years. And now what that bucket will allow you to do is you'll take a little bit out of it every year so that you can live your life. The things that I just mentioned, right? Traveling, hanging out with your friends, spending time with your family, taking, whatever, classes to be more creative, or anything that you enjoy to do. That's all your lifestyle. And your lifestyle needs money to support, right? It's, and a lot of us right now on the call, our lifestyle is being supported by others, i.e. your parents. And so we want to make sure that you understand that at some point the earnings will stop and your investment bucket or pot will then work for you. And we can get into a little bit of that if you'd like, if that's.
Yeah, please.
Yeah. So, as Karan had showed you, if you put $100 away, and that's just an example, but at the end of the day, you're going to end up with this bucket of money. Think of it as a big piggy bank or a vault in a bank, whatever you want to do. And so that bucket will continue to grow at a certain rate based on what the markets have done sort of, in history, and hopefully that they'll do that in the future. Again, there's no guarantee that that'll happen, but they'll grow at a certain rate going forward, and you'll withdraw from that at a certain rate as well. And you want to withdraw less than it can grow. Why is that? So that you can take money out every year to live your lifestyle, and your piggy bank or your big bucket can continue to grow, so that as you get older, you have more and more for you, because we're all living longer and longer with advancements in science. We need to have money when we're retired. So that's the idea. You want that bucket to grow, and you want to take out less every year than it can grow on average over a 5 and a 10-year time frame. And if that sounds abstract, let's say the money can grow 7% a year. Well, you should take out 4%. Why is that? If you have $100 and it grows 7%, it becomes 107, right? And you need 4% of that. So if we still use the 100 as an example, you need 4. It can grow to 7, and then at the end of the year, you're still left with the 100 being even bigger than it was at the start of the year, and it can then grow again for you the next year. And also, the reason we want to take out less than it can grow on average is because there are years when it's going to be down, and the 100 could become 90, but you still want to be able to do all the things that you want to do, and we want to make sure you can do that. So that's why it's really important to start early, which you've seen we've been stressing throughout this call. And it's important to understand that these numbers here that you are looking at represents sort of a harsh reality. This is typically the median retirement account by age, and none of these numbers are enough to support people when they're done working. And that's why you could get such an edge here by understanding this content and getting ahead of the game by investing early.
Yeah, absolutely. We have a question in from a member of the audience. I feel like I'm very late in the game to start thinking about investing. I want to start, but what's the best way to go about it? Are apps like Robinhood good to use, or should I speak to a professional instead?
Sure. So, being in my world where I'm not, people come to us to do investing. So, the apps have a role, for sure. I think the apps are great to get excitement and bring and encourage younger audience, people with smaller amounts of money, to get started. They can also be dangerous, because you can follow big trends in the world. And we've seen these meme stocks and things like that, which just have sort of caused all sorts of chaos, in my opinion, but they've also brought awareness. So I don't think it's ever too late to get started, first of all, to answer that question. And second of all, I think that it just depends on how much money you're starting with that you want to invest, whether you should speak to a professional or you should get started with some of the ideas that we mentioned earlier. I'm not sure Robinhood necessarily is the best platform to do that. But Karan, maybe you have some thoughts on that as well, especially being a little bit younger and just sort of thinking about things in the market.
Yeah, I mean, absolutely. I think there are a number of really good platforms that you can use, and Robinhood is definitely one of them. But I think it's important to understand kind of the fees behind the platform, why they're charging you the price they're charging you, and what you're getting for that, right? So personally, I use Fidelity. I was able to open a brokerage account for no fees. And they also don't charge me a fee per transaction. Now, there's a little bit of a difference in the way they charge the price of the actual stock. But I think that the way that I think about it is, instead of having to pay $20 or $30 per every time I want to buy something or sell something, maybe it's a penny more expensive than I'd be able to find it elsewhere. When I think about apps, I think at this point you can buy stocks or even options to some degree, which Sapan maybe you can talk about in a minute, on a lot of different platforms, whether it's Venmo or Cash App or Robinhood or wherever. And while some of that is really, really good for, just getting started and trying to dip your toe into the water, as you kind of learn a little bit more about it and kind of want to start to access more information and get deeper and kind of put more money onto the platform, it's important to also know that your money is safe. And so with a lot of those platforms, or a lot of the larger platforms like Fidelity or Vanguard or TD Ameritrade, you have that security. It's FDIC insured, things like that.
Yeah, I mean, I can't speak much to options just because I don't work with them much. And I think that, I think it's also really important, we see this a lot where folks get into things that they sort of don't understand, and it sort of mothballs and, snowballs onto itself, where you're kind of doing it on your own, and then you get caught up in sort of what's on TV and what market commentators are talking about. And it's sort of easy for it to go the wrong way. I think what we've demonstrated and showed here is that the power of having a diversified portfolio with a long-term view is really quite powerful, and sort of, I think for folks like us to do what we do, and folks like you to do what you do, that we all charge fees for the money we manage. In the long run, it's well worth it if you're with the right folks that have been doing it and know what they're doing. Which again, it comes from just being in front of people and educating them about what's happening.
Right. And you mentioned, listening to people on the news and listening to kind of what the market at large is saying. How important is that? When should you be doing that? And when, what are good signs to not listen, maybe?
Yeah, I think that's a great question. I as a consumer of information, I think, you can speak to this as well as two people that sort of their DNA comes from doing research around companies and industries and, the economy. I personally, really enjoy consuming my news in a written format. I find that, television commentary has become very sensationalized here in the last probably decade, that it's difficult to sort of parse what is sort of made for TV and theatrics versus what's factual. So, I really like consuming media in a written format, and I'll do it from the right wing, the left wing, whatever terms we want to use, Republican, Democratic newspapers, and maybe some of our audience is even surprised to know that newspapers tilt in a certain direction, but they certainly do, versus people screaming at each other on television. I do think where the commentary is really helpful for folks like us on TV is when you have the actual people that are managing money and they come on television as guest hosts and they speak, and they're allowed to speak and have a platform. I think is really powerful because they're oftentimes speaking and talking and discussing what they are actually doing, with their own investment assets that they're managing money for some of the largest organizations and institutions in the world. And I find that very helpful. I'll tell you, in our office, basically after the financial crisis in 2008, we sort of turned the TVs off and have never turned them back on, because it's become sort of shouting matches at each other. We have access to so much information when you're in the markets, and we pay for information through various news searches and things like Bloomberg and all of this stuff. And so we just find it very helpful to consume it in that format.
Yeah, it definitely makes sense. I mean, when I think about written information, right, you mentioned Bloomberg, you mentioned a couple other sources too.
Financial Times, amazing resource. The New York Times, the Wall Street Journal, all the major newspapers. I personally love the Financial Times. I'm a big advocate of it, a big fan of it. And Bloomberg is sort of an aggregator. They have their own content, but they also, have a news feed that basically, for the audience, Bloomberg is basically a research service. It's much more than that. Started by Mike Bloomberg many years ago, and many Wall Street professionals and investors pay for what we call the Bloomberg terminal, where we have the machine, and it can trade. It provides enormous content on stocks, on bonds, all sorts of news, live content, and all of us sort of at times are glued to our Bloomberg machines. We call it a machine, but obviously the software runs on any computer. But there was a time when you had to have a Bloomberg computer and a Bloomberg monitors and Bloomberg everything. So, which probably would shock everybody on this call as well. But
yeah, no, I've used the Bloomberg terminal maybe once or twice. It's definitely interesting.
Yeah.
So another question from the audience, if I believe that AI, ML, and VR industries will make money, is there an industry specific version of the S&P or of these indexes that
Sure.
I can invest in?
That's a good question. I'm not exactly sure if there's a AI index. So let's explain to people, I think, and take a step back, sort of what that indexing or ETF concept represents. So as we described earlier, when you turn on the TV or you read the newspaper, what will you hear? You'll hear, what did the S&P 500 do today? What did the Dow Jones Industrial Average do today? And what did the NASDAQ do, right? And those are market indices that represent baskets of real companies that we mentioned: Google, Apple, IBM, Microsoft, on and on and on and on and on. In the case of the Dow Jones Industrial Average, it's 30 securities. The S&P 500 is 500, and the NASDAQ, I believe, is many more. So what I would say is, because we're very much interested in AI, VR, and all of big data stuff at the firm, is we do that by being invested in things like Google and Facebook and Amazon and Apple, because they're all cutting edge companies that are all using it in their daily lives. And again, we're not advocating to buy any of those stocks. We're just talking about sort of how we play it. And so, a lot of those companies are referred to as the FANG stocks, Facebook and Alphabet and Apple and Netflix and Google. Netflix obviously uses tremendous amounts of AI and data to get you the content that you want, and so you could see what's trending now and what you like when you sign into your Netflix. So as to specifically if there's a VR bucket or AI bucket, I'm not sure. Facebook obviously does a lot of VR, and a lot of times what we refer to as pure plays, which is what the person who's asking the question may be asking, is sort of all they do is that. A lot of times they're private companies, and so it's hard to sort of necessarily do that in a public space, because a lot of those companies are early on and they're in that research phase, and they're in your world, Karan. They're things you're looking at. So, but I'm not sure. There may be an index. There's an index, for example, that represents biostocks, and when the COVID pandemic and things like that, right? That was a good way to play that and do that as well. So,
yeah, absolutely. I mean, indexes are a really great way to kind of get what's called exposure to certain industries or certain
I think the hard part
areas of the market.
Sorry, the hard part is just that when you do it, is to sort of then monitor it, right? What you bought last year might not necessarily be good this year, and then you get caught up in your day job, and it's difficult. And that's one of those things that like you were asking me earlier, where folks like us come in and can really help once the money gets to be to a certain point.
Right. And I want to kind of jump back to the portion on retirement, but just one last question actually on that. If I'm starting out, I maybe only have a few $100s or maybe a couple $1,000s to invest. How do I think about, creating a balanced portfolio if I don't just want to do all in, on the S&P 500 or all in on the Dow Jones?
I think the S&P really represents a balanced portfolio. I think it's too tricky to sort of think about, well, I should have an ETF on AI, I should have an ETF on a pharmacy, because I just think that's too difficult.
Right.
So again, not advocating that anybody should buy anything or sell anything, but just that I think the S&P 500 represents a broad spectrum and is a really good place to start for any of the dollar amounts you're talking about in the audience.
Yeah, absolutely.
It's done tremendously well for the last several decades. I mean, it's astounding.
Right. Yeah. Makes sense. So kind of jumping back to thinking about retirement, financial planning in general, things like that. Our audience is, in high school. How should they be thinking about saving and dividing up their income?
Sure, that's a great question. And I think, hopefully this helps everyone understand a little bit in terms of sort of it's far away and it may feel abstract, but what I like to tell people is that what's the rainy day fund, right? And so, right now you're living at home and, you're with your parents, you're with mom, you're with dad, and you're not on your own yet. But let's fast forward to a time when you'll be on your own and you've graduated or you've decided to, do, some professional skill that you're now working and you're earning money. I like to tell people whatever that rainy day number is, meaning if something were to happen to them with their job, what amount of months of savings would they feel comfortable having? And so that's a personal question that I can't answer. It can be 6 months, it can be 9 months, it can be 1 year, where you feel confident you'll find a job within that time frame of the same sort of level. And at the same time, during that time when you don't have a job, you don't want to change your lifestyle. You still want to spend time with your family. You want to go out, you want to spend time with your friends, you want to hang out. So above that rainy day fund, I think at a young person, what we've been talking about the whole time, it would be hypocritical not to say that the rest should be invested. And, I would certainly start with that sort of broad spectrum representing, the US market via the S&P 500 for quite a while until you get to a certain dollar amount.
Yeah, absolutely.
I think that rainy day context hopefully helps them sort of take what might seem like far away about a retirement to sort of, what do you need to live and the rest you should invest. And you have the opportunity at a young age to quote unquote be aggressive because you have such a long time horizon and you're only going to do better in life. So.
Right. And so, you mentioned, and I think we actually had that chart up earlier of how much people often have for retirement. How much should you have for retirement? Like, what is a good way to kind of benchmark that and start thinking about that?
Well, that's a great question. I think that goes back to lifestyle, and it's really hard for the audience at such a young age to figure out or to understand because it's so far away when you're 18 and you're not going to retire until you're 65. But it goes back to lifestyle, right? And all the things that you want to do. And so you're building to that goal of sort of being able to maintain your lifestyle once you're older, at an older age. And so I think that those conversations are really another reason why having someone in your life like me is it becomes an ongoing iteration every time you get together, right? We typically meet with our clients twice a year, 4 times a year. And every time we do that, we can then talk more about sort of what is happening in their lives because it's constantly moving around and it's constantly changing. So there is no abstract, there's no concrete answer in my mind. I would say that, you're going to probably have some lower expenses once you retire because you're not, for example, if you have a family, you're not putting your kids through school anymore. At a certain point, that goes away and things like that go away, but it's still going to probably be a healthy relative percentage of what you were spending in your pre-retirement years. So let's say you were spending, $100,000 a year, which probably sounds shocking to the audience, but, is something that's going to be quite realistic, if not more. You probably need to have 80% of that a year left over, right? So if you needed $80,000 a year, how many years are you going to live after retirement? And you can start thinking about it in terms of that. But I think the best way to think about it is invest early, start saving early, put your money to work early so that your money can work for you as you get closer to your retirement years.
Yeah, absolutely. And another question, from the audience. Hi, I'm 17 and I started earning money over the summer. I have been told that it would be a good idea to put some money in a retirement fund. What are the benefits of a retirement fund? Can you withdraw money without a penalty, and how do they really work? And so, but I think this also speaks kind of towards the idea of like a 401k and an IRA that I think we saw on one of the pages.
Sure, that's a great question. I wish I had one of my partners on with me who, is really the expert in all of that. But let me just conceptually explain it, and maybe we can get some more info to the Fearless cohorts back, and you folks can sort of, post another document about retirement and which account to open. But the concept in a retirement account is the money would grow tax-free. So what does that mean? Typically, if you bought something, and let's say you buy it at $1, and then it goes up and it's worth $10. So you have now bought something at 1 that's worth 10. Therefore, you've created a $9 gain. So when you have a gain and you sell, okay, it's important. If you don't sell, nothing happens, whether you're in a regular account or a retirement account. So if you buy stocks and you never sell them, then you don't have any tax issues. But if you sell them, the government wants their share. And then the taxes all depend on sort of how long you've owned the stock. If you've owned it for over a year, it's what we call long-term, and it has lower capital gains. It has a capital gains tax, which is lower than if you're working right now in a summer job and you get your paycheck and you look at it and you say, where did my pay go? Well, that's what we call ordinary income tax. And that's a much higher rate than if you bought stocks and owned them for long term. So stocks can be treated when you sell them on short term and long term. So I know a bit winded answer, but I think it's very important to understand that that's taxes. So if you have a normal brokerage account, if you open up an account that's not a retirement account, that's what we call a taxable account. And every time you sell something, if it went up, you have what we call a gain. And the gain will depend again on short or long. Also, by the way, if you sell something and you're wrong and you lost, that's a loss, and you can use that to offset any gains in your stock portfolio and maybe other things as well. We're getting into a little bit of taxes that probably out of my area of expertise, but those are what we call regular taxable accounts. So to the person who said, I'm 17 and I'm being advised to open a retirement account, in a retirement account, if you buy or sell, and let's focus on buying, let's focus on selling, because that's when the taxes occur if you have a gain. And for a 17-year-old, we're hoping we're going to have lots of gains because we're not going to sell for a long time. Those gains would not have any taxes in the retirement account because it's a retirement account and you're not taking the money out until you get to a certain age. I believe it might even be age 70, but we can check that. So then, but the beauty in that is that, let's say you bought something at 1 and now it's 10, all of those gains can be reinvested into something else. So you bought Apple 20 years ago, you love it, and now you found the next Apple and you want to buy that. Or like I mentioned, we want to buy a diversified portfolio, and so we want to keep adding more to that. So then the money can grow again, and that compounding comes in. So now you're compounding current tax-free, right? Which is incredibly powerful. Yes, there will be penalties if you take it out before, but you can also have that taxable account that I described as well. And you can have them both going, because let's say you do really well in the taxable account, but you're older now and you want to buy a house, or you want to do renovations, et cetera. You want to pay for education. You can use the taxable account. The retirement account, 401k, Roth, et cetera, those are all retirement accounts. They're going to grow for you in the long run, tax-free, so that when you get to the retirement age, your piggy bank has become many, many, many piggy banks. And then when you withdraw every year, there's a mandated formula by the government based on your age. You'll take money out every year. When you take that out, you will have taxes on that, but that will be treated like as if you were working. So now you're retired, that would be like your job. So depending on how much money you take out, based on how big that bucket has become, or that pot, you'll be paying taxes then in that given year, but nothing like you would have been paying if you were selling on those big gains all along. So I know that's a lot, but hopefully some of that got through.
And one more question on that. Why does the government do this, right? Why do they let you kind of put it in, tax-free now and take it out with taxes later?
Sure. So I think the biggest point there is to encourage people to invest and save. And that's why we've come up with these sort of savings schemes, and scheme here is being used in a really good sense. So it's a way to encourage people to save money and allow it to grow tax-free.
Awesome. And so how do you think about asset classes, right? So if I'm thinking about stocks and bonds, and there's so many different asset classes out there, what should I be looking at? What should I be thinking about?
Sure. That's a great question. So when we talk about asset classes, we talk about stocks and bonds typically. So stocks provide the opportunity for really, really big growth. That Apple example is a perfect example where what we call that capital appreciation. Capital is the money that you've put in, and appreciation is what happens when it goes up, right? And so, Karan, just give me 1 second. So we want to have that appreciation, and that is what equities or stocks allow you to do. They allow for capital appreciation to occur. You can turn that $1 into 10, you can turn it into 100, etc. And that's why we talk about stock classes. That's why we talk about, oops, sorry guys, my running a little low here on the battery. Apologize. Okay, perfect.
No worries.
So, real live problems here, technical difficulties when we're live. So stocks can grow over long-term capital appreciation. What they can also do is when companies are growing, they also can provide dividends. And so stocks can give you capital appreciation and dividend growth. That's what we refer to as one asset class, equity securities. Second asset class is bonds. Bonds can provide protection. So typically, if you're investing in bonds, you want to preserve your money, right? Versus capital appreciation, you want to preserve your capital. And so there are all sorts of bonds, but let's talk about bonds being issued by the United States government, which are deemed the safest bonds in the world because they're backed by the full faith and credit of the United States government. So your risk is the government collapsing, which in 08, was kind of there. But that was a 1 in 100 year event. So a lot of people, when they want to preserve capital, they will invest in bonds. The safest of all the bonds are the US government bonds, and they'll provide interest as well. In the current environment we're in, I'm sure many of our students on the call here have heard their parents grumbling about how low interest rates are, and if you go to the bank, you can't really get any interest. We're living in a low interest rate environment world for lots of reasons, but that determines what interest companies and governments have to pay to borrow money from people like us, because essentially, when you're buying a bond, you're lending it to someone. So you're giving the government $100, and they're promising to pay it back to you in 10 years or 20 years. And along the way, they're going to give you interest for being able to keep the money for that long. Well, interest rates are really low right now. So personally, we've avoided the bond asset class and we've focused on the equity asset class. Number one, to find those amazing growth companies like Google and Facebook and Amazon and Tesla and Microsoft and on and on and on. And also to supplement them with companies that can provide dividends for people that want more security. So think of your Colgates of the world that do toothpaste, or Clorox. So there's Procter & Gamble, which makes so many household brands. Those are thought of as more defensive companies because they don't grow as much, but they're also not supposed to have too many hiccups. There's no such thing as not supposed to. So they all ultimately eventually do. Think of product recalls or things like that happen, but they're deemed safer. So they're dividend stocks. They're not going to double or triple over a very long time frame, but they are going to provide you with income. So if you invest in them, you'll get sort of a coupon every year back, along with some principal growth. So hopefully that's an understanding, that gives people an understanding there.
Yeah, absolutely. And you mentioned interest rates. Someone just asked in the comments, what percentage of a person or family's net worth should be kept in the bank versus being invested? And I guess let's assume that you're not thinking about it a really short-term investment like buying a house or a car or anything like that.
Yeah, sure. Well, this is a great question. This is sort of what we were talking about earlier, and I can speak to it directly from our clients. And what we see, it really goes back to sort of what is the number you're comfortable. Let's say we're talking about an older folks, established families, et cetera. What number are you comfortable that you can support your family in a time of crisis, right? And so you lose your job, you both lose your job, you and your spouse, you're a single spouse provider, you lose your job. That's the number that only you can answer because it's a very personal question and personal decision. And so is it 6 months? Is it 9 months? Is it a year? Typically, it really doesn't need to be more than that. The rest of your money sitting in the bank is doing you really no justice or no service. It should be invested. And that's what we advise our clients, and typically most of our clients, that's what they do. And how that's invested can be with us in terms of as equity and bond managers. It can be with folks like you that are providing a bucket of venture capital. So it can be diversified amongst that. But history has shown that if you're sort of making the bet that the United States is going to continue to do what it does in terms of what we like to say, attracting capital, allowing for entrepreneurs to grow companies, sort of being the best and safest place for people from all over the world to put money in, then history shows that it's an enormous creator and generator of wealth, of growing your assets so that you can allow and help families and help your own families do all the things that you want to do, right? So it's providing for your children, it's helping put them through school, it's investing and donating in causes that you care about, it's helping family members when they get in times of need. All of these things happen because that bucket, that pot can grow. So it, for people that aren't used to the markets or haven't been exposed to them, it sounds daunting, but it really should be anything above your rainy day fund should be invested. And the reason why I like the public markets is because when you are, if you don't have sort of the guidance and counsel of a professional, then I certainly wouldn't recommend doing it that way. But if you do, which there are tons of good ones out there, and if you do that, then in times of stress, if you really, really are uncomfortable, you can always hit a button. And what do I mean by that, right? The markets are very liquid and you can sell even during times of duress. You might not like the price, but you can sell your stocks, a certain portion of your investments, and you can raise money, right? If you're invested in real estate or if you're invested in assets that don't trade on a liquid market, the stock market, it's more difficult to sell them when people are not feeling good about the future economic prospects. And so liquidity is a big reason why I'm a big proponent of investing in the markets, in the equity markets, in public markets, because you can be invested and you can always hit a button and get out. You might not like the price, but you can sort of cut your losses, which we don't throughout history, we have not advised, and it's always been the wrong thing to do. I'm sure everyone here has heard of Warren Buffett, and he loves to quote and say that, he wishes he invested the day before every crash. And if you think about that, what he's telling you is that ultimately markets recover and continue the trend from sort of left to right if you were looking at a chart, like many of those charts you put up. So it's a great question. Again, it's a very personal question in terms of what people feel comfortable around the rainy day. And I think that's the biggest, sort of point we try to stress to clients and potential clients when working with them is that everyone at the table has to be very comfortable around understanding risk, understanding volatility, and sort of being on the same page and taking the same long-term vision. We say no to many people because if they're just not a right fit, it doesn't work for both parties involved. We can't, so we're not looking at the market tick by tick. We're looking at it in 3 months, 6 month, and 2 to 3 year blocks. Truthfully, not even 3 and 6 month blocks.
Right. Right.
Just one last thing. I know it's a little bit long on this topic, but
I'll go for it.
We don't think, for example, when the financial crisis happened or COVID happened, that these amazing companies that have allowed us to function, things like Microsoft and Amazon Cloud and our iPhones, we didn't think overnight they were worth 20 or 30% less, right? But the market was saying they were because stock prices went down dramatically, right? And so those are reasons, those are times when it shows you that markets can remain irrational, and they can remain irrational for longer periods than, sort of we enjoy, but usually, things return to normal. And so those are great examples of why staying the course, if you've sort of set aside the amount of money that makes you feel comfortable that's not in the market, can sort of pay dividends in the long run.
Makes sense. So I think one more topic here that I think a number of our viewers will enjoy and have been asking about. Let's talk a little bit about cryptocurrency. And I know we also have a resident crypto expert as well, Deepali, who is one of the co-founders of Fearless Plus and also has done a lot of work in the cryptocurrency and fintech space. So Deepali, I guess, why don't you introduce yourself and then, what are your perspectives there?
No, thank you, Karan. Hello, everybody. You guys know me. I've been in around these expert series for some time, but my day job actually covered fintechs, payments, and crypto, which has obviously been around since 2014 or so, maybe even earlier, but we really started to get a bit more mainstream in crypto around that time. So for a lot of our Fearless Beta cohort, there has been a lot of discussion on our Discord on cryptocurrencies and should I buy Dogecoin and all this stuff. So why don't we just break down crypto very, very quickly for those of you that do not know what a cryptocurrency is. So cryptocurrency is a kind of digital money that's designed to be secure and in many cases anonymous. And it can be bought and sold using hundreds of online exchanges, and you probably have heard of them like Coinbase and others, right? So cryptocurrency uses a decentralized technology to let users make secure payments and store money without the need to use their name or go through a bank, right? Which is a mind-blowing concept, right? How do you buy and sell things, or how do you get money that's not in a bank, right? So it's all run on a distributed public ledger called a blockchain. So I know many of you have probably heard some of these terms and you may not know what that means. We at Fearless can put out a little bit of a blog around this as well if you're more than interested. But basically that distributed public ledger called a blockchain, it keeps a record of all the transactions and it's updated by all the currency holders, you guys, whoever. So a lot of you guys have probably heard of Bitcoin or Ethereum or even Dogecoin. So when popular individuals like Elon Musk, who's the CEO of Tesla, mentions their name, those digital coins can go up and down, which creates, a lot of volatility. Now, I think a lot of you are probably questioning cryptocurrency. Is it a good investment? If you want direct exposure to a digital currency, you may want to dip your toe into it. We're not advocating for that or not. It's really hard to imagine a future without cryptocurrencies because clearly that is where the trend is. So I'd kind of throw it back to Sapan in terms of, I know that he's an equities expert, but as an investor, what do you think in terms of cryptocurrencies being part of your portfolio?
Sure. I think it's a great question, and thank you for the background for your audience. I think it's helpful. It's helpful to all of us. I think it's something that we're all, in sort of the traditional finance world trying to understand every day. I think that the blockchain, as an example, has tremendous implications for all sorts of things that we do in our everyday lives, whether it's the food we eat to the medicines we use, what we think of as the supply chain. I think there's tremendous applications for it. I think what the investment community is struggling with is that the big argument for sort of Bitcoin, for cryptocurrencies to replace traditional currencies is sort of, we think, in our world, probably a very, very, very long-term view and vision, and who knows if it'll be correct. I think where we struggle is you notice and see that cryptocurrencies have tremendous volatility. They go up and down in value, on a daily basis, and the money in your wallet does not go up and down in that kind of value anywhere near that, especially in the US, in stable countries, stable governments, the US, Western Europe, United Kingdom. And so I think that's where we're struggling in understanding where cryptocurrencies fit into someone's portfolio. And I think it's a great way to sort of wrap up here and talk about how diversification is so important, because cryptocurrency, as they probably pointed out, has a role to play, whether it's the currencies themselves or the rails, like the train rails, which would be the blockchain that they ride along on, where they would fit in. And what I would say is, when we're making that basket of securities for folks, or you're buying that basket, if you have $100, split your $100 into 100 pizza slices, or 100, if you have one pie, cut your pizza pie into 100 slices. And a few of those slices should represent some of the more cutting edge investments like cryptocurrency, like blockchain, and how that fits in as it sort of develops over time, because, these are great opportunities, but they can also be great failures. And we want to protect and have everyone understand here that you will fail along the way to becoming a good investor, to becoming educated about the markets, to finding a good financial partner to talk to and talk these things through. and failure is okay in this case. It's very important to learn from. And the best way to sort of offset the shortcomings and the failures that will happen in the portfolios is to be by being diversified.
Makes sense. And I think that's a really good point to close on too. You know, when I think about crypto, it's something that I'm super excited about, but there is an inherent risk to it. And so, you know, when you're thinking about just starting out and maybe, you know, playing, so to speak, with whatever amount of money you want to do that with, that's probably a better idea than, you know, putting your life savings into it. And because it can go all the way up or it can go all the way down, and there's really no telling what tomorrow holds in that sense.
And as we covered, we definitely don't want to invest life savings in anything. The first savings should be the savings to run your life, your family, your fund, your expenses, etc. And after that, we should be having a lot of pizza slices diversified in the pie.
Yep. Yeah, absolutely. Well, everyone, thank you so much for joining. Again, this has been Fearless Plus's Intro to Investing panel. Sapan, Dipali, thank you so much for joining and for all of the expertise. And Dipali, any last words?
No, I would just say thank you everybody for joining, and a big thank you to Karan for moderating this panel. We're super excited to have him as a fearless mentor. He's been legendary as a mentor, and he keeps bringing on more mentors. So thank you for that. And Sapan, as always, thank you for your expertise. And for those of you that are listening in, we do have these curated apps and things that we have put together for the beta cohort that we will be making public. So we will be sharing some documents on our social media and other platforms. So stay tuned for that. But everybody have a great afternoon, and a big round of applause to Karan and Sapan.
Bye, everybody.
Thank you, guys.
Everyone.